Welcome back to Investing Talk Podcast.
Today we're looking at Comerica.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are looking at a really high-stakes banking drama today.
Oh?
It's centered on Comerica, a company that has pretty quietly built one of the most reliable commercial lending operations out there.
And the current situation is interesting, right?
It's fascinating. You've got these undeniably strong fundamentals, but then the stock is caught up in this huge merger conflict.
Which creates a lot of catalysts.
Exactly. So the sentiment might look kind of mixed on the surface,
Yeah.
but when you peel back the layers and see who's actually buying, it tilts, well, pretty decisively bullish.
That sets the stage perfectly. It really sounds like a case of solid business performance meeting, a lot of market uncertainty.
Mm-hmm.
Before we get lost in all the merger headlines, let's just anchor ourselves in those fundamentals. Their recent earnings momentum, for one, has been just remarkably consistent.
It has.
It's not just that they're beating estimates, it's how consistently they keep doing it.
And that consistency is, this is the foundational piece of this whole thesis.
Mm-hmm.
When we analyze banks, predictability is gold, and Comerica, well, they provide that.
So let's look at the numbers.
Okay, look at recent history. For the third quarter of 2025, they reported an EPS earnings per share of $1.35.
When the consensus was expecting what?
Only $1.28. That might sound small, but that 5.47% surprise, that translates directly into institutional trust.
And crucially, that wasn't some anomaly. You have to look back to see the pattern developing.
You really do.
The second quarter of 2025 saw an even bigger beat, right? Over 15%. And Q1 was up by more than 10.
Right. When you see 3 straight quarters of just blowing past expectations like that, it suggests one of two things. Either management is guiding very conservatively, or, and this is more likely, their core business is just performing better than anyone on the street is modeling.
And you think it's the latter?
It's the latter. And you could trace it to 2 specific things. First, their operational efficiency is just.
Mm-hmm.
It's impressive. They run a tighter ship.
Mm-hmm.
And second, there's just accelerating demand for what they do, especially in those core commercial lending segments. They absolutely dominate.
So the momentum is real.
So strong that even though the current Q4 projection is at $1.27, analysts are already signaling, a strong possibility for upward revisions.
It's a company that's earned the benefit of the doubt.
It has.
And that reliability translates directly into real benefits for shareholders. That's another signal of just how healthy they are financially.
Talk about the dividend.
Yeah, they support a very robust dividend, 71 cents per share quarterly. That annualizes to $2.84.
Which gives you, what, a yield of around 3.2%?
About that, yeah. And that's a powerful floor supporting the stock price.
And that floor is reinforced by their capital structure. Their debt is manageable, but the real statement of confidence comes from who owns the stock.
The big money.
Institutional ownership.
Right.
We're talking the big funds, the hedge funds, pension funds.
Yeah.
It's sitting at a massive 80.74%.
Wow.
That level of concentration tells you these sophisticated players are highly convicted. They believe in the long-term viability of this company.
Now, that's a key transition point. Institutional investors don't pile into a bank just because of one good quarter.
No, they don't.
They invest because of the moat. So let's dig into that competitive advantage. What is it about Comerica that makes it worth so much to these big funds?
It's their entire strategy. It's built around specialization, and that's the source of their moat. The middle market commercial lending franchise.
Okay, so they're not trying to compete with the big guys like JP Morgan or Bank of America.
Not for national consumer accounts, no. They are a highly targeted, a very specialized commercial lender.
And define middle market for us. Why is that focus so important? Isn't a loan just a loan?
It's fundamentally different. Think of it less like a giant supermarket and more like a highly specialized boutique firm.
Okay.
Over 90% of their entire loan book is commercial exposure. The middle market means established businesses, companies with solid revenues, but maybe not the global name recognition of a Fortune 500.
So the relationships are stickier.
Incredibly sticky. They involve complex, tailored financial solutions, not just standardized products you can get anywhere.
So it's about high switching costs. If you're a mid-sized manufacturer, you can't just move your entire financial operation to a new bank without major disruption.
Precisely. And those high switching costs, They act like a physical barrier. They protect them from the larger national banks that really just prefer volume over these deep, specialized relationships.
They become partners, not just vendors.
Exactly. They defend market share through operational integration.
And they don't stop at just lending, right? They enhance this moat by offering complementary services.
They're selling an entire ecosystem. Once a business is tied into their commercial lending, Comerica then cross-sells services like high-level treasury management.
Which is critical for cash flow.
Critical.
Yeah,
And then they also offer wealth management services directly to the business owners themselves. It's an integrated approach.
So they capture revenue streams that might otherwise go to some external advisor.
Right. They become the single financial hub for the business and the entrepreneur running it.
That makes perfect sense. And I see here that strategy is also fueling growth in their M&A advisory services.
That's a fantastic linkage. Because they're so deeply embedded with these successful companies, they have a front row seat to their entire life cycle.
So when a client wants to buy a competitor or sell their own business,
Comerica is the first call. It allows them to capture these huge M&A advisory fees. It's a very efficient, self-reinforcing growth engine.
okay, we've established the foundation is strong. Now let's shift to the stock's actual behavior. The price action has shown, real resilience despite all this drama.
That has.
How do the technical signals back up this narrative of institutional confidence?
Well, despite all that merger uncertainty, the stock is trading around 87.74 and just holding up very well.
And it's staying above a key level.
Very important. It's sitting well above a critical technical and psychological level near $74.
And that $74 mark is significant because...
Because it was the consensus analyst target before all the merger drama even started. It's like the pre-catalyst valuation floor. The market believes the company is intrinsically worth at least that much on its own.
And visually, on the chart, we are seeing a constructive pattern of higher lows. For listeners who might be less familiar with charts, what does that mean in plain English?
It's a key sign of institutional accumulation. It means every time the stock dips, buyers are stepping in at a price that's higher than the last low point.
So the big funds are using any volatility.
Any negative headline as an opportunity to load up. They're confident enough in the eventual outcome that they're not waiting for it to get any cheaper.
That accumulation is showing up in momentum signals, too. I'm looking at the surging implied volatility in the January 2026 options. Why should we see increased volatility as a bullish sign here instead of just a signal of fear?
That's where context is everything. Implied volatility just measures expected price movement.
Right.
In this case, where the event date, the merger vote, is known, the high price people are paying for those options is signaling they expect upside movement. Traders are paying a premium because they anticipate a major positive price spike.
A very specific bullish trade.
Exactly.
And we're seeing confirmation from the street itself. Analysts are moving. We've seen firms like Wells Fargo, RBC, Morgan Stanley, all issuing recent upward price target revisions.
They're basically validating what the charts and the fundamentals are telling us.
The narrative is aligning. Earnings are strong. The moat is deep. Technical show accumulation. But now...
Oh, we have to talk about the elephant in the room.
We absolutely have to pivot to the single biggest factor here. The potential $10.9 billion merger with Fifth Third.
This is the crux of it. This is what's creating both the current ceiling and the potential for a massive breakout.
And the critical event everyone's watching is the shareholder vote. That's scheduled for January 6, 2026.
That's the day.
So what's the clear upside if the deal gets approved?
Approval unlocks massive integration synergies. You instantly create a much larger regional banking powerhouse.
So they can cut costs, streamline operations,
and leverage the strengths of both institutions. Fifth Third's bigger footprint with Comerica's superior commercial focus. This is where that asymmetric reward potential really comes from.
Okay, you mentioned asymmetric reward. Let's pause on that. Define what that means in this specific situation.
It means the potential reward is far greater than the risk of downside based on the current price.
How so?
Well, if the merger fails, the stock is defended by the strong fundamentals we talked about. The dividend, the high institutional ownership, that $74 support floor. The downside is limited.
But the upside?
But if the merger passes, the upside from synergy realization and the immediate re-rating of the combined bank is substantially higher than where we are now. The risk-reward is just dramatically skewed toward reward.
But that potential upside is being challenged by a very loud bear case. We have to address the activist pushback, mainly from that group, Holdco.
Right. They're generating all the uncertainty.
What's their core allegation?
It's simple, really. They believe the company is being fundamentally undervalued in this deal.
In the exchange ratio.
Exactly. It's a stock-for-stock deal. 1.8663 shares of Fifth Third for every share of Comerica. Holdco is arguing that ratio just does not adequately compensate shareholders for the high-quality franchise Fifth Third is getting.
They're saying management is selling the company too cheap.
Basically, yes. And that pushback creates this volatility. This is the noise that institutions are buying through.
So we have to counterbalance that activist rhetoric with the institutional reality.
That's vital. While Holdco is vocal, we look to the proxy advisors. They influence how that 80% institutional base votes.
And the big one is ISS.
Institutional Shareholder Services. They are the largest group advising these major funds, and ISS has recommended approval of the deal.
That is a massive endorsement.
It's huge, and it suggests the deal is likely to succeed, despite the noise from the activists.
And we're seeing that confidence in the actual money flow data. Who is positioning themselves for this vote?
Look at the accumulation. Funds aren't waiting. They're positioning now. A Semiconductors, for example, they boosted their stake in Q3 by over 52%.
Wow, how many shares is that?
About 175,000 shares. The smart money is clearly betting that the ISS recommendation carries the day.
Okay, but let's entertain the fun, speculative scenario. What if the deal doesn't go through? If the vote on January 6th fails, what happens then?
If the vote fails, the situation changes immediately. But the thesis doesn't just collapse. There are these persistent, unconfirmed rumors that Holdco claims Fifth Third would be forced to raise its bid.
To get the deal done.
Right. But more importantly, a failed merger instantly puts Comerica back in play.
Meaning a bidding war.
Precisely. That middle market franchise is a highly desirable asset. If the merger collapses, rival suitors, maybe a strong regional player like Regions, could step in.
Which would spark a bidding war.
And that provides a massive speculative upside. It ensures that even if this specific deal fails, the fundamental value of Comerica prevents a significant freefall.
So the company either realizes value through integration synergies with Fifth Third or through an increased bid and potentially a bidding war.
Either way, the pressure is upward. That summarizes the catalyst-driven nature of this perfectly. We're talking about events that are scheduled and imminent.
Let's put this on the calendar for our listeners. What are the key dates?
The next 4 weeks are absolutely critical. January 6, 2026. That's the big one, the shareholder vote.
Resolves the merger uncertainty one way or the other.
Right. Then, just 2 weeks later, January 21st, we get the Q4 2025 results and the conference call.
And given their history of crushing EPS estimates.
That day has a high probability of generating positive movement on its own, regardless of the merger status. It adds another layer of security here.
And all of this company-specific drama is happening against a pretty encouraging macro backdrop for the whole sector.
That's the final tailwind.
Yeah.
The broader economic picture is favoring financials, particularly regional banks. The consensus is for the Fed to begin rate cuts into 2026.
Which tends to be good for their net interest margins.
Exactly. It helps stabilize and eventually boost their NIMs over the medium term as their funding costs normalize.
And if we see a broader rotation back into financials, companies like Comerica with that superior commercial focus and clear profitability are perfectly positioned to capture that interest.
To synthesize this for an elevator pitch, you have a consistently high-performing commercial lender. Its specialized moat drives, earnings beats, and fuels massive institutional accumulation. The whole company is positioned for an asymmetric reward based on the resolution of this merger in early January. This isn't a long-term hope. It's a high-probability, catalyst-driven scenario designed to get a significant re-rating in the first quarter of 2026.
The question for you, the listener, isn't just whether the merger goes through because the institutional signals suggest it probably will, but whether the current price truly reflects the deep, specialized value of that commercial franchise, even if the deal collapses and that hypothetical bidding war begins.
To keep up with our analysis on companies facing these kinds of high-stakes asymmetric catalysts, make sure you hit that subscribe button.